Sandeep, it's a pleasure for us to have you here today to talk about your book, to take us through your personal journeys.
When markets are doing well, when we are doing well, we feel very good about ourselves.
So interestingly, you said that this is for the benefit of the retail audience.
Investors get a better return from investing in a diversified equity portfolio.
The spelling of good luck has a Q in the end. So what is the reason for that? So that is when you said you became rich. And then shortly after, the global financial crisis hit in 2008 and you said that you lost 50% of that wealth. Welcome everybody. I'm Eesha Gupta. I'm a business development manager in Estee Advisors in the Good Luck team and a leadership team member in the company. I'm extremely thrilled to have with me Mr. Sandeep Tyagi, who's the esteemed author of the book, The Little Book of Big Gains. So a little bit about Sandeep as well. Sandeep is a computer science engineer from IIT Delhi and he's pursued his MBA from Columbia University in New York. He has over 30 plus years of rich experience in computer science, analytics, portfolio management and the capital markets. He is the founder and CEO of Estee Advisors, where we are currently. It is a quantitative investment management firm. And like we read in his book, Sandeep's passion is to help people invest well. So Sandeep, it's a pleasure for us to have you here today to talk about your book, to take us through your personal journeys. And we are really looking forward to learn from your investing principles.
Thank you, Eesha. Always good to come and talk and connect the dots on what we are doing here and what kind of products and books and articles and blogs that we are trying to put out there to educate people about investments.
Great, great. I'm sure we are going to learn a lot from him today. So I'll start, Sandeep, with the most obvious question that everybody may have. What inspired you to write this book and what do you expect and what do you hope people will learn from it?
The book originated from two sources. One was just some personal conversations with my own friends and family members, where I realized that a lot of them do not have basic understanding about investments. And I'm talking about people who may have MBAs, who are very well educated.
Right.
And I'll put myself into the same bucket 15, 16 years ago. I also did not have very good understandings of how to put together a personal portfolio and investments, even though I had an MBA from a top university. It's not something you learn. So the personal experiences with friends and family, my own experiences when I had to put together a personal portfolio were one big driver. And the second big driver was in ST, we have always served large institutions, large companies, high net worth individuals. And we have not really created products and services which are relevant to everyday investor. So I wanted to put these two things together and create something which would give the benefit of what we have learned to every investor.
Interesting. So interestingly, you said that this is for the benefit of the retail audience. Similarly, Good Luck, which is one of the divisions in the company. So how did you go about founding that some years back?
Well, originally Good Luck was meant to be a brokerage company. So we started it with an idea, Good Luck is the piggy bank or the place in which we all saved money for buying toys as a kid. So we thought it's a good symbol for getting into the habit of saving. So we created this business and brand with the mindset of saying, let's help everybody understand how to do investments and savings. That broking company has now morphed into more of an investment advisory business, a business that helps 20,000 investors get a better return from investing in a diversified equity portfolio.
Got it. And the spelling of Good Luck has a Q in the end. So what is the reason for that?
Well, that's the gods of internet. That was the spelling available for the website domain. So we went with that.
When I meet people, I tell them, look, we are a quant investment firm. So the Q is representing quantitative methods of investing.
Well, let me rephrase my answer. Q stands for quant investments.
Okay, great. Okay, so Sandeep, a little bit about your journey. In the book you mentioned that in 2000 you founded a company called Inductis, which merged with another company and went to market in 2006. So that is when you said you became rich,
Mhm.
and then shortly after the global financial crisis hit in 2008, and you said that you lost 50% of that wealth. So how was that experience, and what were your learnings from there?
Yes. So I've been an entrepreneur three times over. I was a junior partner in a firm from 94 to 2000. Sold that business in 2000. Then I was a founder CEO of a business called Inductis that merged with another company, which went public in July of 2006. And when something like that happens, you just feel rich. It's not the quantum of necessarily the money you make, but you feel good. You're feeling proud of your financial success and achievements. But when the financial crisis hits, the flip also happens, because as you lose a lot of that wealth, at least on paper, you feel not rich. You feel stupid, and the emotional journey and roller coaster is actually very important in your well-being of your financial journey. So what happens is, when markets are doing well, when we are doing well, we feel very good about ourselves, and that encourages us to take more risks, do some silly things. And when things are not going well, we feel bad, and that forces us to sometimes do, again, stupid things, very conservative risk avoidance things. And then oscillation between this greed and fear defines a lot of people's investment journey. And it's kind of like trying to go from here to here, but you go like this.
That's true. That's true. And a lot of people leave the markets also when they face a lot of returns, like you said.
Yes, and in the book, we cover a very interesting case study. There's a famous fund called Magellan from Fidelity, where over its lifetime, the fund produced over 24% annualized return, but the average investor in the fund ended up losing money.
Right.
And the reason that happened was they came in when the fund had done really well, and they left after the fund had done poorly for some period of time. As a result, everybody came in at the peak and left at the bottom, or most people, and did not do well as much as the overall fund did. So chasing performance is very common, and the problem with it, it's always in the hindsight mirror. You are always trying to do what has happened or avoid what has happened, and it's not the best decision, because things change all the time.
That makes sense. In fact, I wanted to ask you a question which maybe you've already covered, that what is the one biggest mistake people as investors have? And just to build on to it, you mentioned even people who have MBAs. So for example, I have my batchmates from ISB who were working in like big industries, big firms in marketing and product management. But when we talk about investments, they don't know what to do. They put their money in FDs.
Yes.
What are the kinds of one biggest mistake, let's say, you think that people should avoid, and how can they avoid it?
Yes, I think people do a lot more work than they need to do. And unfortunately, they make a lot less money than they can make. So it's putting more effort and getting less, which is not a good recipe. If you talk about what are the most common single big mistakes, I would say it's in terms of not understanding how to put together a basic savings portfolio, which starts with having wrong expectations. So either people are too afraid, they only want to put in FD, or they are too greedy. They think, like last year, the stock market is going to go up 40%, and that doesn't happen. So people get disappointed. So wrong expectations, then too much concentration, familiarity bias. You are familiar with an industry, you have heard of an industry, you like a theme, and you over concentrate. You are only in that one type of investment. So that becomes a big problem. Performance chasing, where we just talked about, you're looking at what has happened most recently and only focusing on that. When you put all of this together, it comes back to that image: doing more, getting less.
Makes sense. Okay, so I think we've always used in Gullak also this analogy of different car gears representing different risk tolerance levels. And you've mentioned about it in the book also a bit. So if you could just elaborate it for our listeners.
This is an analogy I've used to describe the core elements of how to think about asset allocation. What is asset allocation? Asset allocation means mixing ingredients or investments into your portfolio to achieve your desired outcome. Now, why do you need to mix things in different ratio? Just like driving, what happens is, depending on the condition and your own skill, you choose to drive a car in a particular way. If it's raining, if it is dark, you're on a hilly road, you put your car in first or second or third gear maximum and you drive cautiously. If you are on Delhi-Jaipur highway, it's bright early morning, sunny, roads are empty, you may go much faster in the top gear. If your car has 6th gear, you're going to put it in that and you're going to go. Similarly, in investment, depending on your emotional makeup, your needs, you either drive your portfolio with a lot of conservatism built in, that means low gear, or you build in a high equity portfolio if you are able to afford it. So the mix depends on you. It is determined by your own skill and situation.
That's a great analogy. I think that will help the readers also and the viewers also understand really what we mean by risk appetite and how to map it. Okay. So you've structured the book into 4 different parts. So for our audience also, if you could just, take us through it and how it helps us in making our financial plan better.
Yeah. The book is called The Little Book of Big Gains. Actually, the book could have been even littler. I could have written the book in half the number of pages. And the reason for that is the first section of the book is basically about how to put together that systematic plan that you need. And we could do it in relatively few pages because it's simple. It's simple but made difficult in the way people implement it, the way they deal with their own emotions. So the second chapter of the book talks about what to avoid. That's called avoiding the noise. Very difficult. We are constantly bombarded by a lot of experts on the TV, on internet, on YouTube, on social media, blogs, even newspapers, where what you're getting is a mix of many different types of advices. Right. And it's difficult to make out what would really work. So avoiding what doesn't work is equally important as knowing what does work, because otherwise you can keep getting distracted and going off track. The third part of the book talks about how to then maintain what you have learned and put it in practice. So keep track of it, rebalance it properly, monitor it, understand the costs that you're paying in doing your investments, understand the tax implications and how you can optimize those things. So all the things that go in maintaining a proper investment portfolio is covered in the third chapter. Finally, I did provide a 4th chapter for people who are interested in going deeper in the journey of investments. We have a team of 120 people. We have hundreds and thousands of data points that we look at and constantly are building portfolios and investment theses. So we do a lot of research and work. And we gave a glimpse of what that process looks like in that final chapter for people who want to go a little deeper and look inside the hood and say, how is it that we are able to do the kind of investment advice and selection that we do in our professional products.
Yeah, very interesting. It's structured really well. And I think, like you mentioned also in the book somewhere, that we know it's very simple as to how to maintain a good diet and how to, get the bodies that we want, how to look good. You have to eat right, you have to do the right things. But we all want that magic pill or that magic diet, which could help us similarly in investment, something that could help us achieve returns instantly, or
Yeah.
that one stock or that one advice. So
Yep.
I think you're really encouraging people to focus on what matters and stay away from the noise, focus on what you need to do, and then implement it, not just read about it, but implement it as well.
Yeah. Keep it simple.
Keep it. Yeah. All right. Okay, so one interesting thing that we've heard, in one of the webinars of Good Luck, I read a comment where a person says, hey, we thought you'll give 50% returns year on year, but you're not being able to give 50% like we thought. So we see that because of the recent years of the bullish activity that's happened in the markets, the expectations of people have become slightly unrealistic. Where my father, or let's say my grandfather, they would say what they expect from the markets for whoever invested is hard 8 to 10%, and they'll be very happy, annual return of 8 to 10%. But now the expectations have changed. So what is your take on helping people understand how to set realistic expectations?
So the expectations for people get very quickly shaped by what has happened in the most recent past. In the last 2 or 3 years, the average return in the markets have been 20+%.
Yeah.
Last year, the return was 40+%. So people who have started investing now or are looking at the markets in the recent past obviously expect that that is what markets do.
Yeah.
On the other hand, in 2008, if you looked at anybody, they would say, look, if I can make 3, 4, 5%, I'm doing very well. So you keep oscillating between these extremes. Now, the way to address that is to look at patterns over very long periods of time. In the book, we talk about almost 90 years of data in some parts. And in India, it's shorter, about 30 years of data. But still, you can see that over long periods of time, stock markets tend to give, say, about 15-16% return. World's best, or at least most famous investor is Warren Buffett, and Warren Buffett has generated about 20%, just under 20% return since 1965, compounded. So even the best investors, if you can generate in that range, you're doing very well. Markets would generate 12 to 15% over time. Indian market is in a very good phase, so maybe it can generate 15 to 18%, but not much more than on an average basis. So your expectations should be tempered by long-term information rather than what has happened in the most recent 10, 12 months or 2 years.
Got it. So people should really, when they're evaluating investment products also, they should have the expectation of long-term and then see which one to go with.
Yes. I mean, last year, our portfolio in last 12 months produced 68, 69% return. But that does not mean that could be set as the expectation. So very important. At the peak, the stock market has also produced 80+% returns. It has lost 50% as well. So you have 1 year volatility of anywhere between -50 to +80.
Right.
But you have to take what is average to set your expectation, especially if you think about your investment returns in long-term periods. Over lifetime of saving, what do you expect to make?
Right. Okay, Sandeep. So in your experience, what does good investing look like?
The best investing is the one that is steady. It's easy, it's calm. It is not all over the place all the time. So pretty much anything that you do in life, if you know the basics of it well, if you are well grounded in it, then you go through it in a very stable, calm, peaceful way. People who are unsure about what they are doing, every time something changes, your market is down 1%, you suddenly are looking at getting rid of everything. Or you heard of a tip on how to invest from a friend and suddenly you want to go and do that thing, which you have just heard about on yesterday's dinner. That's not good investing because you are too fickle. You're changing your mind very, very quickly on very little additional information. Good investing is understand the corner basic building blocks of a good investing plan which does not get shaken by month to month, week to week, even year to year happenings in the market. That's what you should try to achieve. In the book, what I've tried to cover is building a plan like that. What are those building blocks? How do you understand them? How do you put them in place? And once you have that framework in your mind, then you would be more like a big ship in the ocean rather than a small boat which is getting thrown around by the waves all the time.
Yeah, I think that's a very potent way to look at it, because I can also imagine applying this in, let's say, fitness or in the work we do at office.
Anything,
Yeah.
when we understand something and we have high conviction of what we understand, then are able to maintain it.
Yeah.
You're able to maintain a diet, you're able to maintain your health regimen, you're able to maintain your study habits, your work habits, even relationships.
Yeah.
When you're consistent and you follow a certain basic set of principles which are value based, you know them deeply,
Yeah.
then you're able to hold them and stick to them.
I'm definitely going to take this with me. This is good learning from the interview. All right. Okay, so as the CEO of ST Advisors, you've pioneered quant-based investing in India. So how has the quant approach evolved in India so far, and how is it different from traditional investing methods?
So quant investing is a broad term. We started in 2008. At that time, SEBI had just allowed machine-based trading. Before 2008, it was not legal in India for a computer to send a direct order into the exchange. So in some sense, it's a new industry, it's a new way of thinking in India at least. There have been two big branches of investment and technologies growth into investment. One is the whole methodology and technique by which we actually execute trading. So use of co-location, computers. Right. We have heard a lot about high frequency trading. All of those technology improvements have made the world of trading completely different from what it used to be 15 years ago. 15 years ago in Delhi, there were probably 10 to 20,000 people whose only job used to be sit on a computer terminal and try to find and compare prices between BSE and NSE and things like that. All of that is gone because computers can do all of that very, very fast. There is a completely different side of quant investing, which is nothing to do with all this computer speed. They are more about computer processing power. And the benefit of that type of quant investing is that unlike a human being which is trying to make a decision, how much information can a human being process on a regular basis? A machine can take all the information for all the stocks that you want to look at in a very consistent basis every day. And that's what we do. And that part is growing nicely. As the quality of information becomes better, you are not working on inside tips or other rumors, but on systematic data. What happened in the balance sheet, in the income statement, what is happening in the market, then quant investing works better. And that's what we have been focusing and seeing the growth of.
And like we know that Gullak was established to democratize investment advisory for retail investors. So, how do you see technology and automation shaping the future of investment management for retail investors?
So, I think in investment management, there are two parts. There is the actual manufacture of a product or investment. So, if I'm going to give you one size fit all. Now, in Gullak, it's not one size fit all. We do, for example, investment in 6 gears. So, depending on your risk level, we give you a different product or at least suggest a different product that you should use. But it's still 6. It's not individualized to you as a person. Now, when you take the technology to the next level and you say, I am going to give you proper advice that is relevant to you and answer your questions. You may have something in your mind that you want to ask, but I'm not able to do that today if I'm just giving you Gullak Gear 6. Right. That part, I think, is going to get transformed in next 10 years in a big way. How? Well, what is going to happen is today, only high net worth individuals, maybe who have 5-10 crores of investable money can afford to get a proper financial advisor who will answer all their questions and help them prepare their plan and do all the work for them, answer their questions, maintain their records. You need a certain amount of money because of course people have to be paid if they're going to give you that service. So you need a certain amount of money to be able to afford those services. But technology will change that dynamic. And the reason it will change that dynamic is now we can build all of that capability of answering your questions, of personalizing that advice to you as an individual. Given your situation, given your financial condition, I can give you a personalized, correct financial advice. And at a cost which is much lower than if it were done manually by a human being. This change will make the world world of financial advice go into the next level, where it will be available to an investor who is trying to invest 10 lakh rupees or 5 lakh rupees and would not have a human financial advisor be available to them to get proper structuring thoughts and answer their question. But with technology, we can. So I think that I see as a big potential next step in the industry. That'll be great. Just like today, we do not have anybody who helps you necessarily with travel. 20 years ago, when we used to buy tickets, or maybe 30 years ago when we used to buy tickets, there was nothing available online. You used to go to a travel agent and they gave you a little booklet with little paper tickets inside that. Now it's all online. And you plan your own travel journey. You have online resources to get all the information. Something similar and even better can happen with what technologies are already available today.
Interesting. So while you were speaking about technology doing all of this for us, my mind was constantly going to the thought that how will people feel comfortable with getting advice from an automated source and not from a personal manager. But I think somewhere you kind of answered that question by giving me the travel agent example. Now I'm able to trust computers to do it for me. I was putting in my money. I would have gotten scared whether it's going to the right place, I'm booking the right ticket. Similarly, what do you think, how much time will it take for people to adopt this seamlessly and without fear?
The question is, how does trust get built? Trust is not something you can confer on somebody. Trust gets built by having repetitive, successful experiences. Isn't it amazing that today you can go and buy vegetables from a local vegetable vendor and pay them using a phone and they trust you? Where is that trust coming from? They're not seeing the money. They don't know if the money is going to show up in their bank account. But because they've had the repeated experience that this is going to come in my bank account, which I'll be able to get, they're able to trust the system.
Right.
So successful, repeated experience creates trust. And our goal as an industry should be to minimize the fraudsters, the scamsters, and people who are just there to make a quick buck, but give people repeated successful experience that I can create a good investment journey. I'm actually going to be able to save money. Now, it takes time. Saving is not like buying vegetable that you go and you get an experience and you're done.
Right.
Saving results come over years. So building trust will take time. But with technology, as the famous saying goes, it changes a lot less in the short term than people think. And it changes a lot more in the long term than people think. So I think we'll be surprised how this industry would look 10 years from now. But it may not look very different in a year from now.
That makes a lot of sense. All right. So finally, one last question, which is your one piece of advice that you want to give to youngsters who have just entered the financial markets and who may feel overwhelmed by so much of information out there.
Well, the first self-serving piece of advice is get the book and
Yeah,
read it.
definitely.
But and what you'll find in there is that start early, invest, because compounding is the biggest power in finance. And building a lifetime habit of systematic savings is going to give you a better result than an average investor. And you're going to do a lot less work and put in a lot less effort than an average investor. So don't chase performance. Don't try to time the market. Just systematically keep investing.
Awesome. I think this was such an insightful session, and thank you so much, Sandeep. I think this book is serving as a fantastic guide to not just novice but also to experienced professionals who are already in the financial space to refine their knowledge of their investment strategies and understand complex problems related to the markets even better. So thank you so much for helping us focus on the right things in investing, and
Thank you for all the questions, and good luck to all the listeners in their journey and successful investing.
thanks a lot. Thanks a lot, everyone, for watching.